The bear case for Diversified Energy highlights the company's business model. While Diversified claims it can plug its own wells for $21,000, its subsidiary NextLVL Energy has been awarded contracts by the state of West Virginia to plug orphaned wells at an average cost of $126,000 per well. While management argues that orphaned wells are inherently more difficult and costly to plug than managed PDP assets, critics contend that the six-fold difference in cost suggests that Diversified is deferring environmental liabilities to maintain the appearance of profitability and continue paying dividends. Terminal insolvency and the legal Ponzi scheme allegation. Research from the Orvie and Snowcap Research has raised concerns that Diversified may be technically insolvent if its AROs were adjusted to industry standard levels. In mid-2022, the company's total liabilities, $4.387 billion, exceeded its total assets, $4.033 billion, driven in part by significant hedging losses during a period of rising gas prices. The more extreme version of the bear case, often referred to as a legal Ponzi scheme, suggests that the company's cash flow from aging wells is insufficient to cover its eventual retirement costs. Under this theory, Diversified must continually acquire new wells to bring in the cash flow required to pay existing dividends and service debt, effectively pushing the terminal plugging costs further into the future. Snowcap Research estimates that based on marginally more conservative assumptions, the company's retirement costs could exceed its cash flow as early as 2036. Legal challenges and fiduciary duty investigations. The ARO issue has led to tangible legal and regulatory consequences. In late 2024, Diversified settled a class action lawsuit with landowners in West Virginia, agreeing to significantly increase its rate of well plugging to 2,600 wells by 2034. This represented a 4.5-fold increase over its prior commitments, suggesting that regulatory pressure is forcing the company to accelerate its decommissioning spending. Furthermore, in early 2026, Heifel Law PLLC announced an investigation into potential breaches of fiduciary duty by Diversified's directors and officers. The investigation centers on whether the company materially understated its decommissioning liabilities in its financial disclosures, thereby misleading shareholders. Simultaneously, congressional Democrats have voiced concerns that the company's rosy projections could eventually result in a massive orphaned well crisis that would be left to state and federal taxpayers to resolve.
The bull case, catalysts and strategic upside. The bull case for Diversified Energy rests on the company's ability to execute its circular economy of energy production while capitalizing on structural shifts in the natural gas market. Expansion into carbon credits and coal mine methane. One of the most promising growth avenues for Diversified is its expansion into the capture of coal mine methane, CMM. By acquiring assets that capture methane from abandoned coal mines, the company is able to generate high-margin carbon credits while providing a solution to a significant third-party source of atmospheric methane. In 2024, the company recorded $8 million in EBITDA from CMM revenues, and management expects this figure to grow significantly as it integrates assets acquired from Summit Natural Resources. This segment effectively allows Diversified to be a net-zero solution provider, using its well-plugging expertise and midstream infrastructure to mitigate methane emissions from other industries while generating a non-commodity-linked revenue stream. Natural gas demand, LNG, and AI data centers. The fundamental demand for natural gas in the United States is being bolstered by two long-term structural trends: the expansion of LNG export capacity and the rising power demands of AI-driven data centers. Diversified is strategically positioning its portfolio to benefit from these trends. In 2024, the company announced a fixed-price contract for gas delivery to a major Gulf Coast LNG export facility, ensuring high-margin takeaway capacity for its central region production. Furthermore, the company has begun exploring unique partnerships to provide reliable power solutions for data centers, leveraging its existing wellbore infrastructure and pipeline network to provide a behind-the-meter energy source. As the Appalachian region becomes a hub for data center investment, exemplified by the 2025 Energy and Innovation Summit in Pittsburgh, Diversified's proximity to demand centers becomes a significant strategic advantage. Portfolio optimization and non-core divestitures. Diversified has become an active manager of its own portfolio, moving beyond just being an acquirer. Through its Portfolio Optimization Program, POP, the company realized over $144 million in proceeds in 2025 from the divestiture of undeveloped leasehold acreage and non-core assets. These proceeds provide a low-cost source of capital that can be recycled into more accretive acquisitions or used to accelerate debt retirement, further de-risking the corporate balance sheet.
Company overview. As Diversified Energy moves toward full domestic reporting for U.S. issuers by the end of 2025, it finds itself at a juncture. The investment community remains sharply divided between those who view the firm as a resilient, cash-generating machine, providing essential energy during the transition, and those who perceive it as an entity carrying understated environmental liabilities that could eventually compromise its solvency. Diversified Energy's business model is fundamentally distinct from the traditional exploration and production (E&P) paradigm. Instead of allocating capital toward high-risk exploratory drilling, Diversified acts as a professional consolidator of existing production, acquiring long-life, low-decline wells from larger operators seeking to divest non-core assets. This stewardship model allows the company to avoid the steep capital expenditure requirements and high initial decline rates associated with new well development. Central to the company's ability to extract value from mature wells is its proprietary Smarter Asset Management, or SAM, program. This operational philosophy emphasizes internalizing costs and leveraging technology to optimize existing production while minimizing environmental impacts. By concentrating its assets geographically in the Appalachian and Central regions, the company achieves a level of scale that allows for the centralization of administrative functions and the optimization of midstream infrastructure. SAM interventions range from low-cost wellbore maintenance and compression adjustments to sophisticated leak detection and repair, or LDAC, programs. In 2024 alone, the company conducted approximately 152,000 voluntary emission detection surveys, maintaining a 98% no-leak rate on surveyed assets. This level of operational rigor is intended to extend the economic life of wells beyond the typical industry expectations, thereby deferring the eventual decommissioning costs and maximizing the cumulative free cash flow generated per wellbore. A critical differentiator for Diversified is the vertical integration of its well plugging operations through its subsidiary Next LVL Energy. Traditionally, well retirement is a pure liability for energy companies, often outsourced at high market rates. Diversified has inverted this dynamic by developing internal expertise and equipment for plugging and abandoning, or P&A, wells.
This segment serves a dual purpose. It allows the company to retire its own inventory at a significantly lower cost than the industry average, and it provides a revenue-generating service for third-party operators and state-led orphan well programs. In 2024, Next LVL Energy retired a total of 287 wells, including 215 company-owned wells and 72 wells for third-party or state entities. This internal capacity is a cornerstone of the bull case, as it supposedly validates the company's lower asset retirement obligation (ARO) assumptions. However, the discrepancy between internal plugging costs and the fees charged to third parties remains a point of significant controversy. The fiscal year 2025 represents the most significant period of growth in Diversified's history, driven by two large-scale acquisitions that have fundamentally altered the company's scale and production mix. In early 2025, Diversified closed the acquisition of Maverick Natural Resources for approximately $1.3 billion, a move that doubled the company's revenue and free cash flow potential. This acquisition provided a massive entry into the Western Anadarko Basin, WAB, diversifying the company away from its historical concentration in Appalachia. Maverick brought with it not only significant gas production, but also a higher percentage of liquids, including natural gas liquids, NGLs, and oil, which typically command higher margins than dry gas. The integration of Maverick has been characterized by the capture of significant synergies. By the second quarter of 2025, the company had already high-graded its synergy target to $60 million annualized, up from the initial $50 million estimate. These savings were achieved through the elimination of redundant corporate functions, the renegotiation of midstream and supply contracts, and the application of the SAM playbook to the newly acquired assets. Following the Maverick integration, the company announced and moved towards closing the acquisition of Canvas Energy in late 2025. This bolt-on acquisition in the Central region further solidified Diversified's position in the Anadarko Basin. The Canvas assets are highly synergistic with the existing Maverick footprint, offering additional opportunities for operational overlap and margin expansion. These acquisitions have transformed Diversified's production profile, increasing the liquids component to approximately 26% of the total volume. This diversification is critical for mitigating the risks associated with regional gas price fluctuations, such as the volatility often seen at Appalachian hubs like Columbia Gas or Transco Z5.
The primary investment thesis for Diversified Energy centers on its ability to generate high, sustainable free cash flow yields while aggressively amortizing its debt. The company's financial architecture is designed to provide predictability in an inherently volatile sector. The impact of the 2025 acquisitions is clearly visible in the company's reported results. In the third quarter of 2025, Diversified reported record quarterly adjusted EBITDA of $286 million and adjusted free cash flow of $144 million. This strong performance led management to raise its full-year 2025 guidance. While the original guidance for total production remains at 1,050 to 1,100 mmcfe per day, with a mix of 25% liquids and 75% natural gas, the company now expects adjusted EBITDA to reach a range of $900 to $925 million, up from the initial $825 to $875 million. Adjusted free cash flow guidance has also been high-graded to approximately $440 million, while total capital expenditures are now projected to be between $175 million and $185 million. The company's ability to generate an adjusted EBITDA margin of 66% in 3Q 2025, despite the broader industry's inflationary pressures, underscores the effectiveness of its low-cost operating model and its disciplined hedging program. The hedging strategy, insulating cash flow. A defining feature of Diversified is the hedging program. Unlike many producers who leave a significant portion of their production exposed to spot market prices, Diversified typically hedges approximately 85% of its production for the upcoming 12 to 24 months, with layers extending out as far as 5 years. This strategy has proven essential during periods of commodity price weakness. For instance, in 2024, the company's weighted average natural gas hedge floor of $3.26 per MMBTU allowed it to realize prices significantly higher than the average NYMEX settlement, contributing over $151 million in cash hedge receipts for the year. As natural gas prices showed signs of strength in the forward curve during early 2025, the company advantageously added hedge volumes for 2026 through 2029, layering in NYMEX volumes at an average floor price of approximately $3.68 per MMBTU.
Diversified's debt management is unique in the E&P space, relying heavily on non-recourse, amortizing asset-backed securitization, ABS notes. As of late 2025, approximately 70% of the company's consolidated debt consisted of these ABS notes, which are secured by the cash flows from specific producing wells. Systematic deleveraging. The notes are structured to amortize over time, ensuring that the company's debt is naturally paid down as the underlying reserves are produced. Maturity matching. The maturity profiles of the ABS notes are closely aligned with the long-life, shallow decline nature of the company's PDP assets. Risk isolation. Because the debt is non-recourse to the parent company, the financial health of the corporate entity is better protected from localized operational or commodity price shocks affecting a specific asset pool. The company improved its leverage ratio by 20% during 2025, ending the third quarter at 2.4x net debt to adjusted EBITDA, which is within its stated target range of 2.0 to 2.5x. This was achieved while retiring approximately $203 million in debt principal through the first 3 quarters of the year. In early 2024, Diversified reset its capital allocation framework to prioritize balance sheet strength and sustainable returns. The quarterly dividend was set at 29 cents per share, a level designed to be sustainable for at least 3 years even in various commodity price scenarios. This reset provided an additional $110 million in annual capital flexibility, which the company has utilized for share repurchases and debt reduction. Through November 2025, the company returned $146 million to shareholders via dividends and repurchases, including the buyback of approximately 5.1 million shares, representing 7% of the total shares outstanding. This aggressive return of capital is a primary draw for income-focused investors, particularly as the stock has frequently traded at high free cash flow yields exceeding 30%.
The most significant headwind for Diversified Energy is the persistent skepticism regarding its asset retirement obligations, AROs. Critics, including activist short sellers like Snowcap Research and environmental policy groups like the Ohio River Valley Institute, ORVI, argue that the company is systematically underestimating the cost and timing of its well plugging liabilities. The core of the controversy lies in the average cost to plug and abandon P&A a well. Diversified reports an average ARO of approximately $21,000 per well, an estimate it maintains is realistic given its vertical integration and operational scale. However, industry benchmarks and regulatory data suggest that the true cost could be significantly higher. Industry benchmarks, general estimates for decommissioning costs typically range from $50,000 to $150,000 per well. West Virginia orphan well contracts, Diversified subsidiary Next LVL Energy has been awarded contracts to plug orphaned wells for the state at an average cost of approximately $126,000 per well. Pennsylvania DEP estimates, state regulatory petitions have estimated that plugging costs can range from $38,000 for conventional wells to as much as $83,000 for Marcellus shale wells. As a company focused on older, lower-producing wells, Diversified is naturally under greater scrutiny regarding its methane emissions profile. Methane is a potent greenhouse gas, and its management is increasingly tied to the financial health of energy companies through taxes, fees, and regulatory compliance. Diversified has positioned itself as a leader in methane mitigation, reporting a 13% year-over-year reduction in methane intensity in 2024 to 0.7 megatons CO2e per megamillion cubic feet. This represents a 56% reduction from its 2020 baseline. The company achieved the Oil and Gas Methane Partnership (OGMP 2.0) for 3 consecutive years and satisfied Level 4 reporting requirements, which involve more direct measurement of emissions rather than simple factor-based estimates. The company's Smarter Asset Management program is the primary driver of these reductions. By converting pneumatic devices to non-emitting technologies and conducting regular LIDAR surveys, the company aims to reduce fugitive emissions across its 18,000 miles of pipeline and tens of thousands of well sites.
Critics argue that factor-based reporting and ground-based LDAR surveys often miss super-emitter events, large, intermittent releases that can only be captured through continuous monitoring or high-frequency aerial or satellite surveillance. If these satellite observations are accurate, the company could be significantly understating its environmental impact, leading to potential future penalties and damage to its ESG standing. The regulatory landscape in the United States is shifting toward greater accountability for methane emissions. The EPA's updated Subpart W reporting rules, which began their implementation phase in 2025, require more granular reporting and mandate the use of direct measurements for certain emission sources. This is expected to increase the compliance burden and could result in higher reported emissions for companies with large inventories of mature assets. Furthermore, the Inflation Reduction Act's Waste Emissions Charge, WEC, imposes a fee starting at $900 per metric ton of methane emitted above certain performance thresholds, rising to $1,500 over time. While the Trump administration and a 2025 congressional resolution have sought to eliminate the EPA's rule implementing this charge, the underlying statute in the Clean Air Act remains in effect. Until the statute itself is repealed, the threat of these fees remains a long-term risk for Diversified, particularly if independent measurement confirms higher than reported emission levels. The investment case for Diversified Energy must be evaluated within the context of the broader U.S. oil and gas E&P sector. Diversified's valuation reflects a market that is pricing in both its high current yields and its perceived terminal risks. As of early 2026, Diversified Energy trades at a significant discount to its Appalachian peers on most traditional valuation metrics, reflecting a market's uncertainty regarding its long-term liability profile. Diversified currently trades at a forward PE FY1 of 6.4x with a dividend yield of 8.8% and a leverage ratio of 2.4x net debt to adjusted EBITDA. In contrast, industry leader EQT Corporation trades at a significantly higher forward PE of 20x with a modest 1.2% yield and lower leverage of approximately 1.8x. Coterra Energy also maintains a premium valuation with a 14.6x forward PE, a 2.9% yield, and 2.2x leverage. Range Resources trades at a 15.1x forward PE with a 1% yield, while CNX Resources operates at a leverage ratio of roughly 1.9x.
The stock's institutional ownership remains high at approximately 68%, though recent trends show a degree of rotation. In the third and fourth quarters of 2025, firms like Ameriprise Financial and Citadel Advisors significantly increased their stakes, while Vanguard and KKR reduced their positions. Governance has also been in focus following the departure of Randall Wade from the board of directors in early 2026, a move tied to the ownership stake of EIG Global Energy Partners falling below the 10% threshold. This transition marks the shifting of the company's shareholder base toward more traditional U.S. institutional equity investors as it moves away from its private equity-backed origins. Conclusion: the investment case for Diversified Energy Company is a complex synthesis of robust current-term cash flows and significant long-term terminal liabilities. The bull case is firmly supported by the company's operational excellence in the PDP space, its disciplined hedging program which has consistently protected margins in volatile markets, and its unique ABS-led financing model that provides for systematic deleveraging. The company's move toward U.S. redomestication and its expansion into carbon credits through coal mine methane capture represent strategic evolutions that could lead to a significant re-rating of the stock as it aligns with broader domestic institutional mandates. Conversely, the bear case is anchored in a fundamental distrust of the company's ARO and methane accounting. The significant discrepancy between the company's $21,000 per well plugging estimate and broader industry benchmarks remains a mission-critical risk that is increasingly attracting legal and regulatory attention.
If future regulation or independent measurement through the EPA's Subpart Part forces a significant upward revision of these liabilities, the company's dividend-heavy capital allocation framework could be called into question. The decision to allocate capital to DEC hinges on one's confidence in the company's vertical integration premium. If Next LVL Energy truly can plug wells at a cost that is 60 to 80% lower than the industry standard, and if the SAM program can extend the economic life of wells until the end of the century, then Diversified is an undervalued cash flow powerhouse. However, if the critics are correct that these costs are simply being deferred through aggressive accounting, then the company is a high-yield trap facing a terminal insolvency event in the mid-2030s. As the company enters 2026, the transparency provided by full SEC reporting will likely be the definitive catalyst that validates or nullifies the PDP stewardship model.